And Ryan, if you could give me an audio check when I hit the video play button. Okay, we're live. I'm going to go ahead and play this presentation. Portfolio Builder members, welcome to our Thursday trade alert where we are playing the TLT and GDX ETF. It's another downward bet, and we did have a loss today of $1.97 per share, and it should work out to just about that regardless of being assigned. Now do note that the TLT has sold off even more since I put out this trade alert, so your loss may be less than mine, but that means you'll make a little less on this future trade if it does play out. So the strategy here is to predict that the Fed will increase its balance sheet tomorrow before the data is released at the close today. And essentially the assumption is that if the U.S. government cannot sell its debt effectively, it will end up on the Fed's balance sheet. This is an easy way to predict rising yields and an expansion of the money supply, which is bullish for stocks and bearish for bonds. Today's trade alert: if assigned, repurchase your TLT shares and sell to close your January 17th 138 TLT put. If not assigned, buy to close your January 17 133 TLT call and sell to close your January 17th 138 TLT put. The new trade, per 100 shares of the TLT, sell to open the January 24th 136 TLT call and buy to open the 139 TLT put. We have no changes to the GDX position. For every 100 shares of the GDX, you should be buying to open one February 28th $29 GDX put. Trading is risky. See email for disclaimer. So if you're in the GDX position, you have no changes until the week of the 28th on February. And meanwhile, if you are just following us, then you will jump into the GDX position today and own one long 29 GDX put. Okay, let's take a look at today's trade alert. It's another inverted option caller. I've adjusted the risk to require we do get a sell-off to generate a profit. And so you can see the maximum risk today is much less than last week, as well as maximum profits a little less. So in this setup, we are risking $60 or 60 cents a share, which is just under 0.5% of our total position in TLT. And we stand to gain $2.40, which is just under a potential 2% return week over week. So we'd have to pick up $2.80 for a full 2% return. Now, to achieve this return, we do need the TLT to travel lower between now and next Thursday when we close out this position. If you were not assigned, you'll likely have the same return that everyone else had who is assigned. Keep in mind that I did close out this trade when the TLT was a bit higher. It's already starting to sell off as of recording this video. So your loss is most likely less than mine, but your profit potential going into next week will be a little less than mine, so it works out evenly. Now, so far we're up 0.5% in 2020 in January, so we're well on track to hit our 1% return. And in terms of the loss in the TLT today, it's really bad luck. Here's what's happened. Now, keep in mind, from October through December, we were using the TLT as cheap insurance in case the trade deal went down, as we racked up profits in the equities market. Now, going into 2020, we are playing the bond market to the downside and the stock market to the upside. And again, my target is for the TLT to crash to 120 before we see trouble in equity markets. And at that point, we'll be ready to do the exact opposite, bet up on bonds and down on stocks. How long will it take to hit these targets? We'll see. But the easiest way to predict the short-term moves right now is to look at the update from the Fed every Thursday evening. So again, if the Fed cannot increase its balance sheet as the U.S. government is increasing its total debt issuance at rapid pace, This indicates that foreign investors are buying U.S. debt and that the bond market is going to have strength in the upcoming week. And so, unfortunately, that's what happened. Last Friday, the Fed did decrease its balance sheet by $25 billion. And the week previous, it only increased its balance sheet by $10 billion. The average weekly gain since September, when the yield curve had inverted, was an increase of $25 billion a week. So we'll see how it plays out this Friday. There was a massive amount of debt issued today and Monday at the T-bill range, so debts by the U.S. government that only have a duration of 1 year or less were issued this week. In fact, over $140 billion was sold, and my expectation is that a large chunk of that will begin showing up on the Fed's balance sheet tomorrow morning and into upcoming weeks. Now, if that does not occur, I'll be willing to change our stance and be a little bit more precautious on a stock run-up in the near future and expect a potential bond run-up in the near future. The big picture has not changed. The U.S. government is creating too much debt. It's hogging up the balance sheet of JP Morgan and other primary dealers, and this is causing overnight lending to freeze, which has forced the Fed to go into this quantitative easing into 2020 and over Q4 of 2019. So until we see foreigners picking up our debt, this is almost a trap that they cannot avoid, where the Fed's balance sheet will continue to grow, and this will signal trouble ahead for bonds. If we do take a look at the rest of the trade alert, we are up 74 cents a share on the SPY, and the gamma has moved up to the 332 strike from the 330 strike, which it was loaded up on yesterday. That's where SPY owners are willing to sell their shares currently. And we are short the 332 call and long the 326 put, which is perfect for that setup going into tomorrow. Emerging markets were currently flat. GDX were currently flat. Scrolling down now, you can see our return against the S&P 500. And the big goal here is to indicate that our strategy is adept and can react to different market conditions, whereas most strategies do not. They're simply long equities and long bonds and hold your breath and hope for the best. Our portfolio, we can easily design trades to profit from different directions and different assets. And by focusing on the biggest asset classes, it's very hard for us to get overswept by a big macro force. Many investors focus in on a single stock or a single niche and then are blindsided by bigger forces in the markets. By trading the S&P 500, the emerging markets, the U.S. government debt, and gold, you just can't find larger markets to focus on and to generate safe, consistent profits. Here's a look at the current trade alert. If you were assigned, you only close your TLT put, and you will need to repurchase your shares. If you were not assigned, you'll need to buy to close the 133 call and sell to close the 138 put. The new trade again, after you make sure you do have your TLT position first per 100 shares, is to sell to open the 136 call. Now there's a pretty big spread, so you're most likely going to want to use a market order to get this filled. You may not get the best mid price, but that doesn't matter. This is a directional bet, and we will profit if the TLT travels lower, and we risk very little if it does not. Again, about a little under a 0.5% of the 40% allocation in the TLT is at risk. And moving down to our GDX trade, it's a simple bet. We expect that GDX can rise more than the cost of our put option between now and February 28th. By picking up this in-the-money put, you are essentially locking in your maximum loss, which is, in this case, just under 2%. And if the GDX does rise by more than 2% from here to February 28th, we deliver profits in this position. If GDX were to crash from here, we would lose no more than what we've paid for this in-the-money put option as we entered the trade initially. Okay, so let's take a look at some other analysis. The key driver will certainly be the Fed's balance sheet increasing or decreasing, which we'll know at 4:30 Eastern time today, and we'll cover tomorrow morning. But again, I do expect it will continue to increase after the brief slowdown in the last 2 weeks. Now, the gold-copper ratio is a great leading indicator for the 10-year yield. And you can see the gold-copper ratio is clearly pointing up, and this is going to quite likely drive interest rates higher. Here's a look at the Fed's balance sheet, and we can see the very few times that bonds have rallied and stocks have pulled back ever since their emergency meeting in September, which was due to the yield curve going extremely inverted, has been this very straightforward path. So again, I am expecting that this pullback in the Fed's balance sheet will resume into next week. Now, this is the H41 release that comes out at 4:30 p.m. And again, will give us the details on what's happened to the Fed's balance sheet week over week. The only key risk I see is that perhaps they have decided to stop growing their balance sheet and let the markets do its own work because of the U.S.-China trade deal. But again, that does not solve the issue that the government is creating so much debt that it's bogging down the primary dealers, which is mostly JP Morgan, and that's causing the banks to not lend their reserves out, which is freezing the credit markets and the lending markets. So my expectation, again, is that the balance sheet will increase. Otherwise, we're going to have tremendous problems in the stock market and lending markets, and you'll be hearing about repo madness by next week. So if we do see that tomorrow this increase in the balance sheet was not realized, we will be able to quickly change course on Friday and begin betting down on the stock market and reverse our trade on the TLT. I just don't think that the Fed wants to engineer a stock crash right after they got the U.S.-China trade deal signed. Okay, now in this chart, we're going to look at the progress of the yield curve and go back a few months so you can see what I'm talking about. But what I want you to focus on is on the horizontal axis from left to right. We can see the duration of the Treasury, 1 month, 3 month, 1 year, all the way up to 20 and 30 years. And then up and down on the y-axis, we can see the yield. And so here's what's caused the Fed to begin making the moves that they've been making. Okay, so right there you can see the short-term debts were paying a higher yield than the 5-year, 7-year, and 10-year. That's your inverted that's your inverted yield curve, which signals recession and freaks out markets. It messes up the way banks lend money. And so they immediately had an emergency meeting and went into QE. This is where they will stop cutting rates and simply buy up the short end of the yield curve. And so the result has been that they were able to straighten the yield curve out, and it's come at the cost of rising yields. So this has straightened the yield curve into a healthy shape, which is ideal for banks to loan money, to borrow at one rate, and to profit from lending at another rate. And so my expectation is they will continue to pile money up into the 1 month, 3 month, 1 year as this curve continues to steepen. And again, if the Fed does not increase its balance sheet come tomorrow, we can change course. But there was a massive amount of treasuries issued in exactly the front end of the curve, which would indicate that the Fed could easily be picking up this debt and putting it onto its balance sheet if there was not a lot of demand from foreign investors. Now in this chart, we're looking at the German yield curve, which is a great leading indicator for what's coming ahead and the health of China. I think it's going to take a little while for all this China trade talk to really work its way into these economies and see a recovery. So this may not happen instantly, But we can see that the blue line, especially on the long end of the curve, has risen relative to a month ago. So that does mean yields are rising in our leading indicator economy of Germany. So far, all signs do point that our strategy should work out very well for the first 2 quarters into 2020, which is to be long stocks and short the long-term debts of the U.S. Okay, we're getting near launch time, so I'm going to go ahead and render this video. We'll cover the trade deal in greater detail tomorrow, and just let this episode be focused on how we're playing the bond market. Okay, guys, let's see what we got going on now. Let me go ahead and open up. We're up to 25 live. Thanks for joining us. Shout out to Paul. I'm sure you saw Morgan Stanley's downgrade on Tesla today. So despite the bullish prediction for stocks, I'm not sure we can make the same call for Tesla. All right, I'm gonna go ahead and unmute the crowd and see what questions we have. If we do get too much audio, I will go ahead and... Okay, Murray, you got your hand raised. Do you have a question? You will have to unmute your mic. I'm gonna go ahead and unmute the crowd. And this is a bigger crowd than normal, so thank you everyone for joining us. All right, great. So I'm ready for questions, and everyone has their microphone unmuted on our end. You'll just have to unmute it on your end.
Okay, I've got a question.
Hey, Tom, how's it going?
Good. I am out of the SPY because I was skiing the last several days.
Okay.
And should I open yesterday's Wednesday's trade, or should I just wait till tomorrow?
Wait till tomorrow. We're already almost, we're headed towards the profit on that one already. So I would wait for tomorrow for sure. Where'd you go skiing?
Alta, Utah.
Oh,
And
nice.
the snow was great. And we had, there were 20 of us in our group. We had a great time.
Wow. Well, that sounds like a blast.
Yeah.
Let's see. I have a question from Oscar, please.
Hey, Jason. Question. When let's say you're going skiing like that, you're gonna be away for a week. What do you do in that situation when you don't have access to your recommendations?
Sure. So there's a few things you can do. That's a great question. Number one, as you know, the very pivotal data point for us is released Thursday after the market closes. Now, it's not normal for the Fed to be changing its balance sheet, period. So we're not going to have the luxury of being able to have such a strong indicator week to week forever. So right now, they are in a period of distorting markets. And so the bottom line is that if the Fed increases its balance sheet, that means there is a low demand for US Treasuries from foreign investors. So it's just as simple as that for our prediction each week. To answer your question, if you know that, for example, you're going to miss, let's say, our Wednesday trade alert, but you are able to place the Monday trade alert, you could very easily extend the duration or the expiration to that Friday, and you'll get very similar results to our program. You may miss out on some potential profits if we go above the call we've sold, but I wouldn't be concerned about extending a Monday trade to a Friday expiration if you think you're going to miss a Wednesday. However, I would be less on the side of recommending doing that same idea from a Wednesday through a Monday. So if you're going to not be available to optimize your portfolio come Friday, you probably should just go to cash and wait until the following Monday, because right now the change in the balance sheet is such a huge distortion to markets that we can follow that path quite closely, and this will probably last at least the next 3 months. Now they are talking about trying to taper this down and to stop growing their balance sheet so quickly. But the problem is who's going to buy the debt? And so until these yields become attractive, it's going to really be the Fed. So short answer is you can extend the expiration of all these trade alerts and you'll be very safe. I'm never putting on a trade where we can lose more than 1% of our total portfolio in any given period. But during this next 3 months, you might be smart to really try to make it to the Friday trade, because that's when we do get the update on the balance sheet.
Okay, you said not going from Wednesday or what, Monday through the following Monday, or but how about if you from Friday to Friday? Is that good or bad? Because that's
yeah. Any trade I give you on a Friday will have been will have the data point of what's happened to the biggest investor in the world, which is the Fed's balance sheet. So just to put things in perspective, they're growing their balance sheet per month at a rate equivalent to what it's taken Berkshire Hathaway to accumulate in terms of cash. Warren Buffett's entire career has built up a cash position of over, I think, $130 billion right now. Well, the Fed's printing that much money per month right now. So we got the world's greatest investor, an entire lifetime of investment and saving, and essentially just never selling. And the Fed's distorting the markets to that degree on a monthly basis right now. So yeah, if you take a Friday trade, you could extend that all the way to the next Friday and have a very, very intelligent bet going into that full week. And then you could take the following Monday, Wednesday off. So I would definitely recommend that as an easy way to not miss out on the SPY trade and to simply extend the expiration to the future Friday. Oscar, I see you have a follow-up question.
Not to my knowledge, no.
Oh, okay.
I just thought of one. If your portfolio, as it shows up on the screen right now, it's skewed where you have a higher proportionate percentage of assets in the one portfolio or another, do you rebalance it?
Okay, so great question. There is some slack in my portfolio. That's a great question. Essentially, Oscar's saying, hey, as these different assets grow in value or decrease in value, are we essentially rebalancing the positions? So in my portfolio, I'm not. I'm actually just simply keeping the 1,900 shares of the SPY and the 3,800 shares of the other assets. And any cash I'm accumulating from profits is simply sitting there idle. So that's actually one major enhancement I need to create to my software, which would allow me to transfer balances between each portfolio. The way I'm able to report our data so organized per strategy is by having essentially a separate track record for each asset class. And so currently I've had not had the time to create the programming to allow me to move funds from one portfolio to the other. So from that point of view, I'm not taking full advantage of the returns I could be by putting every penny to work. So that's the accounting gets a little tricky when you start moving cash from one portfolio to the other. And so that's the simple reason why I haven't done that yet, but I do intend to. So yeah, as long as you keep that 2-to-1 ratio and put all the money you can to work, you're going to get very similar monthly return as I am.
Yep.
Okay, excellent.
Thank you.
Oh, thank you.
Hey, Jason, I got myself confused a little bit because I think I missed something there. But explain to me again. So if the Fed continues to be accommodative with this overnight market, et cetera, or maybe it's different, does that mean then that's going to support the SPY and that will continue to go up because they're just still in there supporting things, or am I getting that backwards? I got confused.
You got it right. So, and
Okay.
it's counterintuitive. So let me explain that. The Fed has a history of really doing two things. Number one, they wait for stocks to sell off, and then they go into a period of rate cuts. So we saw the sell-off at the end of 2018 in quarter four. And that sell-off was created by the 10-year yield jumping up to about 3.2.
Right.
Okay. So stocks sold off. They went to their go-to playbook, which was simple. They're going to cut interest rates. Okay. When the Fed cuts interest rates, that artificially drives yields lower and creates a positive situation for stocks and allows the banks who've loaded up on the bonds to get out. Okay. So they did that quite clearly in 2019. They did 3 rate cuts, and then they told us that they're going to halt. And by doing that, we actually saw the yield curve invert. And so they switched gears into quantitative easing. So why are they doing quantitative easing? And the simple answer is that there's not enough demand for the US debt. So if there is a high level of demand for US debt, then it will not be stuck in JP Morgan's balance sheet, and it's not going to end up in the Fed's balance sheet. So because there's low demand for debt from the government, it's forcing JP Morgan, who's the primary dealer and has a legal obligation to pick up all issued debt.
Oh, okay.
Instead of it going to foreign investors, which is where we want the debt to reside, it's going to our US banking system, and it's causing the US banking system to run out of cash that they can loan. And so that's what all this repo madness is all about. So if we can see week over week, the Fed has grown their balance sheet, that means they could not sell this debt to buy and holders. And instead, it's clogging up the US banking system. So that's what causes the Fed's balance sheet to grow. They're growing it in a number of ways, but primarily they're picking up permanent increases in their balance sheet at the same time as doing the repo. And so the theatrics surrounding it and them calling it not QE and all that is really an attempt to continue to have confidence in the US banking system. And that's their primary concern, obviously.
So is that part of the reason why we're seeing such a jump in the S&P, for instance, today? Or is that because they were kind of thinking it was going to be a sell on the news, or
we live in a world
short squeeze?
We're living in a world where it works the opposite it should because of the Fed. So let's just say the Fed was not going to manipulate the markets. Okay, if the US government's creating more debt than anyone wants to purchase, then the yields will rise. Okay, if the yields were to rise, that would cause money to flow out of stocks and into bonds. So if you remove the Fed from the picture, what would happen instantly is a stock crash and yields would just jump straight up. Okay, but unfortunately, or fortunately, whether you like the Fed or not, that's just not the world we live in. So the Fed knows this quite clearly, and instead they are willing to distort the markets. So they are artificially driving the yields on the front end of the yield curve lower and freeing up capital for our banking system. And so the banking system and the hedge funds take complete advantage of this, even though it's complete nonsense. And so every dollar that gets pushed into the Fed's balance sheet represents new money that can be loaned out to hedge funds. And so we've seen without failure, if we're in a period of quantitative easing, stocks go up, bonds go down. If we're in a period of rate cuts, you can almost guarantee stocks have just gone down, which is usually what they use as their excuse to cut rates, and that bonds are going up. So normally the Fed doesn't do both at once. And so this works out very well for the bankers. We did the rate cuts 2019. Now we're doing the quantitative easing. So from that perspective, that's quite clear. Now the question is, why did they reduce the balance sheet by $25 billion last Friday? The previous Friday, they only grew the balance sheet by $10 billion. And previous to that, ever since the yield curve did invert, they had averaged, almost without exception, there was 1 month where we saw a reduction in the balance sheet. But like clockwork, they've been growing the balance sheet by an average of $25 billion a week. Let's see, we got a comment that Mark Stoley has written. What the Fed is doing seems like madness and a formula for future disaster. No, you're right. I would agree with you, Mark. And so, you know, the big picture is that these governments have to slow down their production of debt because this will end up in devaluing each government's currency. So if you think about it, if you increase, let's say we all want to buy, let's say there's 3 stocks in the world and all of us together have $100. Well, probably each stock's worth $33. Okay, now let's say there's $300 between our group and there's still 3 stocks. Well, what's the value of those 3 stocks now? Probably $100 per stock. So that's the calculation that hedge funds are making based on the increase in the balance sheet. Increases in balance sheet represents an expansion of the money supply, but we're not expanding the amount of shares. So what ruins the party? Well, if you're in our boot camp, you know this story all too well. We've seen this play out from time to time in history. But if we print too much money, we end up with inflation. And they do their best to hide that inflation as long as they can to keep these rates lower. But eventually, they'll have to hike interest rates to fight off inflation. And inflation creates revolution. So you let food prices rise too much, you let the cost of housing rise too much, you end up with a whole bunch of pissed off people who overthrow the government. And so, so that's really our primary concern when we see the Fed is making these type of actions, is the risk of inflation. Now, on the other side of the coin, productivity is getting better and better as technology continues to grow. So that's the really hard thing that these central banks have to do is as the economy becomes more productive, as there's more people, there should be more money in the economy. But it's when they get ahead of themselves that we see price inflation. Now, if they get behind the curve, then you can see deflation. Deflation's even worse. That's what we saw in the Great Depression. People thought if they didn't make the purchase today, their money would be more valuable tomorrow. So don't buy anything, just reserve all cash and sit back. So that's when you completely collapse an economy. The Fed's goal is to make you think that it's not too bad, but you might as well make the purchase today because your money will be worth a little less tomorrow. So that's the whole idea behind this 2% inflation target, is that they want to motivate investment and spending to keep the economy growing. And so, you know, if you go through history, there's currency wars, there's gold standards, there's all sorts of crazy things that people have tried to do to represent money and the power of their economy. And so yeah, you know, that it's a wild world, but that's the world we live in. And funny as it is, at 4:30 Eastern today, we will get the update and we will have a good idea of what's coming down the pipeline. But yes, I do agree, Mark. It is madness to print $25 billion a week. So that certainly will devalue your currency.
So
over time.
Jay, just real quick, hey, phenomenal explanation. And real quick, Karen, did that explain everything to you?
Well, it does, but that's my weakness is understanding bonds, for instance. So, you ask me again tomorrow and, I'm going to have a difficult time trying to re-explain that again.
Well, hey, Karen, we're going to be here tomorrow and 5 days a week. So just keep coming in and asking questions, okay?
Oh, I know. Listen, having lived through stagflation and everything else, you'd think that I could get this through my head, but for some reason, that's why I have you guys. Keep me straight.
Absolutely. We're happy to help.
No, that was a great explanation, actually. Careful. I love how you really walk it through carefully, so somebody like me that's got this mental block can understand. So I appreciate it. Thanks.
Awesome.
Yeah, well, it's so weird, but everything's because of the Fed. Everything works in the exact opposite manner that it should. So here's another important website. Let me see if I can find it. I have it all on the iPad. But this is something.
By the way, Karen, I'm right there with you.
Oh, thank you. I appreciate it. I hate being alone out here in the cruel, dark world.
Now, Murray, I see your hands raised, but your mute is your mic is muted. If you want to unmute it, I'd love to hear from you.
Trust me, Karen, you're certainly not in the boat by yourself.
That's wonderful to hear. Thanks, guys.
Together, maybe we can all learn.
Yeah, it's all counterintuitive. If we didn't have the Fed manipulating the markets, the exact opposite of our predictions would be playing out.
I'm all about the teamwork, so I appreciate it, guys. Thanks.
Let's see. I know Paul's new. Paul, do you have a mic? You want to say hello to the group?
2550 call.
Okay, I'm trying to pull up the auction details. The bottom line is they sold $140 billion completely in the front end of the yield curve this week. And at 1.55 interest rate, you're below inflation. So I just don't buy that foreigners are picking up that debt, especially as the dollar's weakening, because now they're not going to be able to hedge it against their currency strengthening after a period of the opposite happening. So we'll see tomorrow. If they have not increased the balance sheet, I will be surprised. That's what went wrong on this week's trade, is that we're front running this before it's public data. So that's how we can really make a nice return with this strategy. Now you can see I did optimize because I was wrong last week with my expectation. Only thing I can think of is they perhaps thought the market could handle itself this week because of the fantastic trade news. But now that big headline is gone. And so I do suspect they must grow their balance sheet. Otherwise, we'll have a crashing stock market very quickly. But as you can note, so the difference between last week's trade and this week's trade is the put option costs much less, only 72 cents. And the call option is still approximately $3 in the money. So some differences in this trade versus the last. The last trade would have done well if we went flat or down and had a little bit more maximum profit, but a lot more risk as we know today. This trade has approximately the same potential profit, but much less risk. And so the catch, there's no free lunch. The catch to this trade alert relative to last week is that we do need a sell-off in the TLT to achieve our profit on this trade.
Yes, we do. I'm waiting patiently for that, just so you know.
So yeah, let's say they reduce the balance sheet again tomorrow. We'll certainly reverse this trade, and all we would do, guys, is close the call and leave our put alone, and maybe even lower the put. So.
Well, how am I gonna get out of this now that I'm in?
Oh, there's Paul. How's it going?
Okay, can you hear me?
Yes, sir. How's it going?
Okay. Are you still on the call?
Yeah, we're in the group webinar, so you're with our whole audience.
Oh, okay, yeah, okay. Yeah, I've been sort of in and out because I'm downtown with my wife, and so I wasn't able to sit down and listen to the whole thing. But yeah, I'm excited. So I'm trying to get on track with you guys.
Okay, great. Well, say hello to the group. Thanks for joining us.
All right.
And you can always replay. So if you go back to your email and click the video image, it'll automatically replay for you. So you can review this.
Well, that's what I'll do.
And
Okay.
Jason, I was just checking because I had to double check, but SPY performance is beating the market this year, bud. So hats off to you, man. That's incredible with the amount of protection you have. So absolutely incredible work, dude. Great job.
Thank you. Well, Dean's always the one. If we're losing a penny, he's on my ass right away. That's another interesting thing about trading from a group perspective. And I know from my own personal history, if I'm trading, just solo and I don't have to provide results daily, you're going to make all kinds of stupid moves. Now think about, from my perspective, if we lose even a penny, I've got a whole audience that's on my ass. So we're going to play it safe. We're going to think about everything twice. And so that is an advantage, certainly, when you have to publish your information. And think about all these hedge funds that they take the money in and then they don't report except for every quarter. And suddenly investors wake up one day with the quarterly reports and they lost 10, 20, 30%. So that's just not a luxury we have in this program because we're reporting daily our results. But yeah, so as far as potential returns, I think we can have some I think we can outperform the SPY this year because most likely we're going to have this careless buy and hold mentality into 2020. Because think about it, investors they've had the return of a lifetime in 2019. Everyone thinks they're a stock genius, but that gravy train may be coming to an end as yields rise into 2020. So I think you may see stocks run up and then crash back to where we're at now, maybe even lower. And so we'll be able to generate profits in both directions if accurate. So we could substantially outperform equities in 2020 against buy and hold investors. So definitely looking forward to that. But just looking ahead, the SPY, we could potentially pick up a portion of the 10% return that I'm expecting before yields get too expensive. On the short end of the bond market, I'm looking for a 11% decline in the TLT. So we'll try to capture as much of that as we can safely. In emerging markets, if we can break past the 2018 high at the $52 price point and maybe head up to 59 to 62, we could be seeing a very healthy return with low volatility because of our put trailing each week on emerging markets. So I do think there's a potential for a 15 to 30% return on emerging markets. Now, again, we're not going to capture all of that with our strategy, but that could be a very healthy return for the first half of the year. And then in precious metals, depending on how fast the balance sheet grows, I do think precious metals will be a good performer in 2020. The reason I do want to continue to have that long spot on the precious metals is in case of two things. Number one, if they do decide to cut rates sooner than I'm predicting, then that could be very bullish for the gold market. So that could be a surprise we're not anticipating. And if they start buying the notes and the bonds rather than the T-bills, that would be another surprise that we have not anticipated. That would be very bullish for gold. So if you're wondering why not just go put all of our metal portfolio into the emerging market portfolio, that would be my argument for why not. And so if my calculations are correct and we don't see rate cuts till at least Q3 of 2020, perhaps Q4, it all depends on how fast yields rise. Then most likely emerging markets is the biggest winner for the first 6 months of 2020. And I think that gold will potentially keep up with the SPY. But if I'm incorrect and the Fed has to start really distorting markets sooner than anticipated, then gold's going to be the best performer by far. So realizing that, we have a good idea of what's going to happen, but we have to have an open mind. That's why I keep this allocation.
So now that you've piqued my interest, that we have to wait till late this afternoon, 4:30 or whatever it is, that they make a decision on this. Where do you find that? I'm gonna look. Now you've just totally piqued my interest. It's like, oh, I want to see.
Yeah. So just search the.
Otherwise, I'm gonna be like all night wondering what the heck's going on.
Sure. So anybody can get this H41.
H41.
I'll post it in the. So we're not going to have the luxury of this being such a market mover for the rest of our lives, obviously, but right now we do. So
right.
Let me show you guys how to read it, just so if you guys want to save that link. So 4:30 on the clock, usually they will post this. So you can just sit there and hit F5, which is what I do. And let's just look at the last two pieces so we can learn how to read these. It's not too complex. Okay, so here's the last two releases, January 2nd and January 9th. Now they tend to update the balance sheet, the graph where we can see the line. That seems to update later. So you actually can't sit on that page and get the data as fast as you can from reading this. So all we really need to do is come down to here, total factor supplying reserve fund. And we can see the balance on Wednesday, January 1st. Just a measly $4.2 trillion. So the way I like to read, calculating in trillions can be a little confusing. So rather than calculating in trillions, let's just keep it to billions. So just remove those last three digits. Let me zoom in on this. So we have $4,221 trillion in the Fed's abyss. Most likely will never, ever leave there. The few times they have tried to reduce their balance sheet, we get crashing stock markets, like clockwork.
The black hole.
Yeah, here's the black hole. So really this represents the growth of our economy and increase in productivity. So if they can get away with increasing the balance sheet and we don't have inflation, that does mean our economy is growing. So as much as we like to hate on them, they just don't have a good strategy for how to grow currency and to fairly distribute it. And so right now, the world we live in really rewards the banking system and the business owners and less so the workers. And probably the big picture in the next 10 to 20 years will be more populism and more people trying to take that control back, and they do this through the government. So watch out for Bernie. But here we go, $4,221 billion on the 2nd, and that dropped to $4,197 billion on the 9th. So we can just do the simple subtraction. Now, my job is to actually start to really analyze this section a little bit more. And this will tell us what they're buying and selling. So if we look at this, we have the bills. So during that period, they did pick up $169 billion of short-term US debt. They sold 86 billion of the notes, and they picked up 9.8 billion of the tips. Now, mortgage-backed securities, they sold $228 billion of this asset. And that's really all we need to focus on. So if we see that they are going to start purchasing the notes and bonds right here, that's when they'll be manipulating the TLT to travel higher. So if they are picking up the bills and selling the notes and bonds, that's exactly what we want for our trade alert on the TLT going into tomorrow.
Now that was interesting. Thank you.
Yeah, it's just, that little report.
Well, I mean, it makes sense. You've got a balance sheet, so it's going to go one place or another. It's going to be, assets or liabilities. So there you go. It's a lot easier to see it that way. Thank you. Appreciate it.
Sure. So yeah, you think, okay, if they're buying bonds, well, then that should be good for bond market, right? But the only reason they're buying the bonds is because no one else will. So it's very counterintuitive. And so if nobody wants the bonds, it means there's big demand for stocks, and we're going to grow the money supply because the government's creating so much debt.
And if nobody wants to buy the bonds, let's just take this to the next step. What is it, all sovereigns that are primarily buying these bonds, or is it the banks that you were talking about?
Right. So the primary purchaser of U.S. debt is other central banks.
Right.
But also a huge chunk of it goes, anything that's not purchased by law is going directly to mostly JP Morgan, Goldman Sachs, all these big US banks. So if they're forced by the US government debt, this reduces their reserves and freezes up the credit market. And that means your hedge fund can't borrow money to go leverage into his stock bond portfolio. And so that's when we saw the repo madness. And so JP Morgan's smart. They, by design, they pulled $200 billion out of the repo market overnight and caused this crisis, which forced the Fed to go. Now, let's not joke ourselves. The JP Morgan's good buddies with the Fed. So it's really giving them the cover to make the actions they needed to do. Yeah.
Well, yeah. And plus, didn't they just come out with their earnings report, and it was like, the best FIC that they've had in who knows how long. So, I mean, they're making money.
JP Morgan made more money in the last quarter than any bank has ever made in history.
Yep.
After causing a crisis. So there is a bit of a conspiracy theory out there about why are the central banks doing what they're doing?
Mm-hmm.
And the argument, why are they continually pushing these rates closer and closer to zero and talking about negative rates? Well, the argument is that this would make it extremely difficult for small banks and medium-sized banks to survive. And so if they can cause these banks to go out of business, they can gobble up market share.
Yeah.
And so that's really the scene we're seeing worldwide. It's a world where the biggest companies have unfair advantages, primarily with access to capital, and they just simply pressure everyone out of the market or buy them out.
Right. Well, that was happening even starting several years ago. I mean, like starting 8-9 years ago, when some of these smaller banks, they could get nothing unless they had like $100 million in assets or something. That's why they started merging.
Yeah.
I mean, there were several of them in the region, that I'm in. I mean, I was watching them. It was just happening, and a lot of them were saying that the management was saying, we were restricted on what we can do or what we can buy because we don't have enough assets. That's so they had to merge.
Yep.
Yeah. Interesting. Yeah, I mean, we got another big one coming up in the Southeast, you know, the whole BB&T and SunTrust one. It's whatever they're going to call themselves now, Truist. That's another one that's, you know, doing this.
Isn't that Chad's company out here, Dean? SunTrust? I didn't know if they were part of a bigger organization or not.
Well, they
No.
are now because they got bought, you know, they're going to, the whole merger with BB&T, which is
They're independent, Jay.
Charlotte.
Oh, different SunTrust. Okay. We got some buddies here that have a SunTrust a bank over here that
Yeah, I don't think they're out there.
they do very well.
Yeah. No, I mean, these guys are big, but they're just going to get bigger. That's all. Interesting.
All right, guys. Well, that's our presentation for today. I want to thank everyone for joining us. Sorry about the loss on the trade today. We're still up 0.5%, and I am extremely confident in this prediction for the TLT to travel lower. But I'm willing to change my mind. So we'll keep an update on the H41 release this afternoon, see if the government's able to sling its debt or not. But the big picture remains intact. We already have a 2-year spending bill approved. So we can count on massive debt coming through the Treasury and being pushed into the market. If that does end up in JP Morgan's balance sheet, that means they can't loan money. That creates stock crashes. The Fed doesn't want a stock crash. So I believe over the course of time, we will see the Fed's balance sheet have no option but to grow until yields are attractive enough to take some pressure off the JP Morgan and these other big banks. Any last questions before I let you guys go today?
Just a huge thank you for taking that time to walk me through all that. Thanks.
Oh, my pleasure. Saturday, we do have some content coming out for boot camp that specifically talks about essentially what we just went over, but in great detail with a touch of conspiracy theory in there for you about what these big banks are really up to and what their plan is for a cashless society and conglomerate banks really trying to put everyone else out of business and take up market share. So,
Jason, I must say that the Druckenmiller interview was very, very interesting, and I would encourage everyone to go back and look at that.
oh, it's so good. Yeah, I really enjoy listening to
Yep.
to everything he puts out.
Yeah, if you don't listen to him and you're invested, I would say that you need to rethink your situation, Oscar.
Oh, no doubt. He had some really good points as far as thinking about what's coming.
For the way we trade, he's my hero. He's got the best returns with the least work without having to use artificial intelligence. So really the only hedge fund that's come even close to his returns over the course of history is James Simon, who has had higher returns, but he's done it with about 120 PhDs, and they have supercomputers day trading. Druckenmiller's done it with good old-fashioned common sense and very simple positioning. And so his once-a-year interview on Bloomberg is worth its money. Plus, when you get Jeffrey Gundlach, who's another bear, just like Druckenmiller, making the exact same calls, it's probably smart to listen to two of the legends, especially in the bond market, which those two really specialize in. So yeah, our portfolio is highly correlated and has been this entire time to both Ray Dalio, Druckenmiller, primarily. So
Thank you for sending that.
yeah, my pleasure. Murray, I think your mic's muted, bud. I see your hand has been up. Oh, there he is. Murray. Oh,
I don't know how to make that hand go down.
there you go. Well, hey, it's good to hear your voice, even if you.
So, Jason, phenomenal presentation. But hey, do you want to just pull up the SPY too? I just want to get this recorded. Because, Yeah, and I know you're gonna hate me for this, but yeah, we're 0.7% above the SPY for the year.
You're such a salesman. I'm telling you, Dean.
I'll tell you what, when I'm not performing, he is on my ass. So he doesn't care why he doesn't care why. Oh, wow.
Well, he's known you a long time. He's got permission, you know? That's okay, because you know I'm going to get on you too if I'm really, really upset. So I'm not going to hold back.
329. Let me show you this other cool thing I got, guys. This is one more. This is probably our best indicator for, let me get this one link together.
And so, Jason, so the SPY is at 0.78% for the year. And yeah, we're at 2.5. So phenomenal job, bud. Phenomenal.
Excellent. Okay, so here's an interesting link I'll post for you guys to save too. If you want to know, and I've been looking for something to do this because we used to just look at the option chain, which was nice, but it doesn't quickly add up every expiration and tell you where the market's really betting. This little chart here does that for you. And so we can see, remember yesterday, most of the money was willing to sell their SPY shares at 330. And now today it has pushed up to the 332 strike, just barely. So there's a whole lot of resistance at 332. Oh. Which is exactly where we sold our call. And on the put option side, people are just not betting down right now. Just really not. Which is reason to be alarmed. So right now we have the entire world in this mentality that it's going to be a cakewalk, easy returns, stocks must go up. But if the Fed were to blindside us and not increase its balance sheets as the debt piles up from the government, then this will probably turn into a volatility quake. So if I see that for boot camp members especially, the next time we see the balance sheet reduce, we'll be buying a VIX call option to take advantage of this, because
you know, this is exactly what I was saying, because I always look at the VIX. I mean, I've got it sitting on my screen, and you know, when it was below a 12 handle this morning, I'm going, what are you're crazy, you're all nuts. I mean, it's like Goldilocks, everyone's going nutsy cuckoo. So I saw that, I went, oh gosh, where are we going? And at some point, you know, it's gonna get exhausted. So we'll have to see.
Okay, well, let's play the devil's advocate. Why would the Fed not increase their balance sheet? Okay. So here's something we have noticed. JP Morgan has not grown their equity portfolio. They have increased their bond portfolio dramatically.
Mm-hmm.
Okay, so how do we get that unloaded for a profit? We need a crisis. We need to cut rates. We need to create a crisis. So if the Fed wanted to help JP Morgan unload their bond position, easy. Don't buy the debt, reduce the balance sheet, or just keep it flat for that matter. JP Morgan will be bogged down within a week. Overnight lending freezes, stocks crash, Fed goes into rate cuts. Rate cuts drive the value of bonds up. JP Morgan can then unload it to the Fed, not the market, the Fed, for a guaranteed profit. So I think that'll happen at some point. I just don't right now.
Well, February is a good month. You know, that's usually a lousy month for stocks. So hey, we're right on the doorstep here.
So the alternative, though, is to simply let the yields rise and try to sell this debt to foreigners, which we would obviously prefer to do. So that's my current forecast, is that they'll let the yields rise, let the foreigners pick up the debt, and that in itself will take some pressure off JP Morgan. They're happy to hold on to their bonds for a year or two or three until rates eventually do go to zero. So I think that's the preferable outcome and the most likely outcome. But if we did want to play the devil's advocate, and tried to speculate why the Fed would not grow its balance sheet and push the pressure onto JP Morgan, other primary dealers. It could be to create a crisis for the excuse to cut rates so they can free up these banks' huge bond positions. And so, yeah, we'll be keeping close eye on it. All right, guys. Well, thank you so much. I really appreciate everyone's time. We'll be getting our presentation together for tomorrow, where we'll close out the SPY. If we don't get the result in the balance sheet tomorrow, then be prepared to optimize our TLT position. Otherwise, I do think we can count on this trend for probably the next 6 months, is my best guess at this point. All right. Well, a great webinar. Thank you, everyone, for joining us. And we'll see you tomorrow. Same place, same time.
Thank you, Jason. Appreciate it.
Thanks, Dean.
Thanks, Jason.
Thanks, Karen.
Thank you, Jason. Bye-bye.
Thanks, Oscar. See you guys tomorrow.